And welcome to another episode of Stuck in My Mind podcast. I am your host, Wize, and my guest today is a real estate syndicator, positive, passive, what's going on today? Passive income educator, and the founder of the Wealth Elevator. After earning six figures as an engineer, he realized traditional retirement planning was too slow and built a passive income system that helped him transition into full-time investing. He's participated in over 2.1 billion in real estate acquisitions and helped high-income professionals build scalable, tax-efficient wealth with clarity and confidence. Welcome to the show, Lane. See, I knew I was gonna mess her up because I was thinking about it too much. Lane Kawaoka. Right.
Yeah, thanks for having me. Aloha, everybody. How's it going?
Oh man, how you doing today, brother?
Not
Uh,
bad. Not bad. We're gonna talk a little bit about passive income, a little bit real estate investing, and yeah, see how we can just talk it up a little bit.
all right, so you were earning six figures as an engineer. What made you realize that you had to make a change? Well, that wasn't enough.
Well, I think it's just math, right? I mean, society wants you to invest in the 401k. Wall Street wants you to access investments out there through their channels so that they can get paid. And I think what I realized very early on is if I just bought a bunch of rental properties or invest directly into investments, I would be able to make a lot better returns, save a lot in taxes, and get to where I wanted to be a lot quicker. But yeah, I kind of grew up on this linear path of go to school, study hard, do the 401k thing, and buy a house to live in, which I don't necessarily think is the best idea for everybody, but
Mm.
that was what I did because I just listened to instructions, I guess. So I saved up 80 grand when I graduated college. Took me a couple years with my engineering job, and I was home only on Saturdays because I was traveling for work as a construction supervisor at the time, and I thought that was pretty silly for a young 20-year-old kid to only have this big house to myself for one day. So I started to rent it out, kind of like Turo style. Didn't have Turo back in this is back in 2009, and that's where I got the taste of cash flow. I was like, "Whoa, this is cool." My mortgage, the mortgage was like 1,600. The tenants were paying me $2,200 a month, and I was like, "Wow, this is a lot of beer money that's coming in." And that was kind of where I got this taste of alternative investing, and that was kind of the start of it all.
So what did traditional retirement planning get wrong for high income professionals?
You pay a lot in taxes, right? The 401ks, or what we call qualified retirement plans, QRPs for short. The name of the game is just deferring your income long into the future. And it looks like a bigger amount, but whether you pay your taxes now or later, it's a bit of a wash, except for the fact that where they get it wrong is they assume that most people today in the future, they're not going to be making that much money. They'll be in lower tax brackets, right? Because we have a graduated tax bracket system. The more you make, the more you pay in taxes as a percentage. So they assume that when you retire, you shrivel up and die, you make no money, and you're in a lower tax bracket. But for higher income people, you have investments that produce a lot of money for you, and you very well may be in a higher tax bracket at the time. So it kind of turns that paradigm upside down. If you want to live off Social Security and off the minimal needs, then yeah, you're going to pay less taxes. But for people kicking ass and taking names in life and growing assets, having an investment portfolio, you're going to be the opposite side of that paradigm, right? I'm not giving any tax legal advice here. Every situation is different, right? But you need to kind of stop and think for yourself on where you're going to be in the future. And most of my clients are above $1 million net worth. Mostly in their 50s. Their portfolios are very different than the average guy who has less than $250,000 of assets or some stock exposure to their name. And there is a different sort of operating system that I kind of talk about in my book, The Wealth Elevator, right? Mainly written for accredited investors or people with good incomes, like myself. Like I didn't start off with that much money. I had some student loans, but I was a really good saver. I was able to save at least $20,000, $30,000 a year from my day job. I parlayed that into rental properties that gave me more income, and that increased my net savings every year. Most of my clients today are like around 50 to $100,000 is what they save. But you may not start there, but that's kind of what we call the wealth elevator, right? You got to start somewhere, and you kind of ascend up, and then the strategies kind of change the more and more money you have.
So how did your engineering background shape how you think about investing?
I just follow the numbers, put it on a spreadsheet, right? I mean, part of that was like, all right, if I just have my money sitting in the stock market stuff, 6 to 8% is what they generally tell you to assume, and I pay a lot in taxes at the end, then I'm gonna have this much, right? The alternative is, well, let's invest more directly into investments, whether you own a rental property and you cut out all these middlemen and take some ownership and accountability in managing your own assets. You can make a little bit more yield there than the 6 to 8%. Of course, there's more risk too, right? But here, I would say it's a good risk-adjusted return. But also do it in a format where this is why wealthy people or people in Congress own rental real estate. They get a lot of great tax benefits to shelter a lot of that income. So if you can, it's kind of the analogy is like if you got a race car, part of it is just removing the aerodynamic drag in your face. That's what taxes is. So if you can go a little bit faster and then remove the drag, you're going to go a lot faster than what you originally did before.
Awesome. So what fears did you have leaving a stable W-2 path and taking the leap that you did?
Well, I would say I'm not traditional entrepreneur, right? Like I waited until I had a good amount of assets and a proof of concept into my business today.
Okay.
And for that may, a lot of people in our world, they'll have a bunch of rental properties or real estate syndication deals that they own that are already producing, a good amount of income. Now, that's how much to be comfortable to leave your day job. It ranges, right? Based on your personal tolerances. Could mean 2x your current salary today, could be 1/4. Could just mean a few $1,000s of passive cash flow today, because what tends to happen after you leave your day job, you stop trading time for money, you stop doing frustration purchases, and a lot of things you don't really need to spend money on, clothes, cars. You got to get out of the rat race. So if you were spending $12,000 before a month, you may need to spend less. So I think what we're all trying to do is get to financial independence, which I would define as your passive income that is coming up from your investments is making you more money than what you spend. Right at that point, you're sort of weightless or zero gravity, and your kind of your pile keeps growing. Hopefully, it grows faster than the 3% inflation rate, or really in reality, it's more like 4 or 5% kind of hidden. But that's another subject. But that's the goal. So it's a race to accumulating assets that can produce that sort of burn rate for you, so you can go zero gravity, as the analogy says, or financial independent, or weightless.
So why do you say single family rentals are a trap for serious investors?
Um, I say that to trick you to read my book, all right? Because there's a twist in the book, right? Like when I first got started, and we have a lot of free stuff on my website for people getting started, buying little rental properties, buying them remotely. A lot of it is just a give back, because there's a lot of ridiculous programs out there, charging people $5,000, $50,000 for this stuff that we give away for free. Um, but that's what you do when you're on that first floor of the wealth elevator. You're not yet an accredited investor, under half a million dollars net worth. And that's where I was in my 20s, right? I had a good paying job, but I just saved up my money and used it on 20% down payments to keep acquiring rental property after rental property. I did that for quite a while, from 2009 to 2015. 2015, I had 11 of these rental properties. And at that point, had maybe a few $1,000s of passive cash flow coming in. So it's kind of like a third paycheck in a way. But that's not enough, right? Like most of my clients today, they need at least $10,000 to feel comfortable. So that's kind of where the rental property trap comes into play. Because just speaking from my own experience with 11 rental properties back in 2015, I had maybe an eviction or two every year, some kind of big catastrophe happening, like a flood in the basement or a broken window here or there. No problem, because I had professional property management to deal with the headaches, right? It is kind of annoying to kind of babysit those guys and pay them 10% of the rents, but it is kind of totally worth it. But with 30 rentals, 3x that exception rate, it quickly becomes a job. And what I started to realize as I was kind of maturing myself to become more of an accredited investor is legal liability becomes so much more of an emphasis. When you're under $500,000, you don't have much to lose, right? Like, what are you gonna do? Sue me? I don't have money to collect, right? Like, I'm broke, right? But when your net worth gets to be higher than $1 million, you become a bigger target on your back. So the idea of owning little rental properties, even if you put it in a legal entity for some protection, it's not ironclad. And at that point, the emphasis is like, well, let me get out of the line of fire and just be a passive LP partner, limited liability, and own the same real estate, get the same tax benefits, same equity, but without the legal liability. And
Mm.
then the loans in your own personal name. So that's kind of the transition that happens on the second floor of the wealth elevator. There's more chapters in the book on the higher floors, right? But that's a big part that I think not a lot of people talk about, right? Like there's a lot of websites out there that talk about rental real estate, wholesaling, flipping. Like wholesaling, flipping, to me, that's what you do when you don't have too much money and you need to take more of an active role in this real estate stuff. But make no mistake, it's not investing; it's more of a job, trading
So
time for money.
can you explain the wealth elevator framework a little?
Yeah, yeah. So, sorry, I never did this before, but think of it like a building, right? And you got these different floors of the wealth elevator or of the building. What I created was this framework where like you have different floors based off of your net worth, where you are. And I call this the wealth building journey. Where the elevator comes in is, you read the book, you kind of realize like, hey, there's a little bit of a shortcut between these things. Like I extended these stages very slowly because I didn't really have a official mentor. I didn't have my book at the time, right? I was kind of just figuring this out by myself, and meeting a lot of people, getting osmosis of the best practices, and putting it into the book. Um, but what I realized, a lot of these strategies is very simple, but they're very counterintuitive than what your parents taught you in terms of finances.
And that's a lot of the situations a lot of regular people deal with, right? They're not taught about finances by their parents, so and they're not taught about investments or so any of these things to help them build generational wealth.
Right, right. Because Wall Street wants to make it confusing. They want you to feel inadequate and, well, I don't know what to pick, right? I'm just gonna put it in the hands of these financial planners or these financial products. That's exactly what they want you to do, right? So they can take all your hard-earned money in hidden fees and carried interest. The idea that I stumbled upon is like, well, if you can just do this yourself or do it more directly, right? Like in a syndication deal, you're not the one making the calls, you're just a passive investor. There's a general partnership group that makes all the decisions, but it's a little bit more of a grassroots organization where there's a lot less infrastructure, overhead, and people with their hands out, right? Whereas Wall Street, you have this big, just complex. I mean, how else do they make these huge buildings in New York City and CEO salaries, etc.?
Yeah.
They're not doing it for free, right?
Absolutely not. No.
But they create this marketing mystique of, if you want to invest responsibly and intelligently with the best, quantum or, analysis, AI, whatever, you need to do it through this channel. And I will say that most people should do that. Most people are not able to ascertain risks, build networks, and, you know, nor can they handle, you know, that different risk or reward spectrums. So they should do that. But there are some people out there that like to self educate, like to try things out, or like I did, buy a little rental property. How bad can that be, right? And then you kind of step up from there. There are a lot of people very quietly with multiple millions of dollars to their name that are taking much more of a intentional, more self-directed approach to this wealth building game.
Mm. So, what are some of the biggest mistakes professionals make when investing passively?
Well, let's just talk about rental properties here
Okay.
first. So, if you're not yet an accredited investor, $1 million net worth or greater, to me, you got to start off by rental properties.
Okay.
Um, most of my clients today are above the $1 million net worth, so they kind of skip over this stage, right? But I always think of these things as kind of the fundamentals of investing, especially if you're going to invest as a passive investor in, say, an apartment building. It's good to know how things work on an individual single family home, one unit level. One of the things that I have in my free e-course, the rental value ratio, right? So the idea is you invest in properties that produce a good amount of income, hopefully more than enough to pay its own debt service and maintenance fees, property management, all these hidden costs. So one way you can evaluate properties really quickly is just take the monthly rental price divided by the market value of the property. So people have access to Zillow, right? It's not the best thing in the world, but it's quick and dirty. You take the rents divided by the purchase price, and you're typically looking for something 1% or higher. If people are two steps ahead of me, you already know that all the nice places are the places in New York, Seattle, all of California are all going to be horrible rent to value ratios, right? You're going to find places that are in the dumps, bad areas for $400,000 that's going to rent for $2,000 a month. You're talking about half a percent of a rent to value ratio. No bueno, not going to work. So you look for these situations where the numbers are more on your side. And at that point you disqualify a good portion of the United States there, right? Another thing as a landlord, you want to have the landlords on your side where you're looking more in the red states. I mean, I live in a blue state. So do you, I think. Right? You guys go both ways. But
Yeah,
when
we
you're
both
the
are.
investor, you want to be in those red states, where if somebody doesn't pay their rent, they can't live there. Go figure. Maybe I call that a little bit of a common sense, but um, that's where my original first dozen properties were in places like Georgia, Alabama, Indianapolis, places like that. Actually, I did have a property out in Pennsylvania, out in Newcastle. That's more on the west side. Um,
Yeah.
didn't
Yeah.
have it very long. That's
I'm
out in the
in
middle of nowhere, right? But that's the other thing. You try to stick with areas that are more of these, we call them secondary and tertiary markets. So the primary markets are your huge cities, right?
yeah.
Millions of population. You're just not going to find the numbers work in those places, period. Um, these other second tier cities like Las Vegas, Dallas, Fort Worth, right? Houston, and even some of these smaller um, cities like Tyler, Texas, or Huntsville, Alabama. But you want to find places that have at least a 250,000 population, right? Robust economy, so that if the meat packing plant shuts down, you know, you're not screwed, right? Being a landlord class out there.
Yeah.
But those are, yeah, those are kind of the starting fundamentals for rental real estate.
How can okay. All right, I got a good question. All right. So why do you take such a strong ethical stance against speculative flipping?
Um, so I don't do flipping,
Yeah.
right? Never really did it. But the way that business works, and a lot of people start off with this because they don't have money. So what they'll do is they'll look for distressed properties, and they'll basically find a homeowner that's down on their luck. I think they call them the 3 or 4 Ds: divorce, despair, down on their luck, or like they're just desperate, right? I think that's the fourth D. But you have these wholesalers, they run around and they swindle these poor, unfortunate people out of their houses at usually 50 to 60 cents on the dollar of what their property should be worth, if they just would have just got a damn agent to sell the property. And to me, that's kind of messed up, you know. But whatever, people do this all the time. Um, we kind of do the same thing. We don't get as big of a discount. We do more commercial properties, so apartments. So we typically will work with more sophisticated owners that maybe they had a death in the family, or they just want to divest of certain assets, or a big fund needing to divest of funds or assets in their fund, because of a sort of timeline they're working under. But I think that's, they're institutions, they got money. I just think it's a little messed up to kind of swindle grandma out of her house for 50 cents on the dollar by smooth talking her on the kitchen table. But that's what wholesaling houses is. And you need to get a good deal on a house to make a house flip work, to be able to do it comfortably with a good margin. But again, I never did that, right? I always did the buy and hold right off the bat, 20% down payment, find good properties that cash flowed. And that was kind of how I got started until I became an accredited investor, and then got more involved in the syndications and private placements on the commercial side after.
Yeah. A lot of reasons people don't get into investment properties is because you hear all these stories about these horror stories about being a landlord, right? Because that's a lot of things I hear from a lot of my friends that don't want to own homes, is because they don't want to invest in rental properties because they don't want to be a landlord. They don't want to deal with the headache and everything. Which, like, and you said you got a rental property manager, right? Yes, it cuts in a little bit into your profit, but it also, it's a headache. That one less headache you have to deal with.
Yeah, yeah, but it depends on, like, if you make a good salary, it's ultimately comes down to what your hour is worth, right? You make a decent salary, it's probably makes more than sense to just pay somebody 10% of the rents to manage the headaches for you. Um, Now, when your net worth increases and you can get into more of these syndication deals, you can pay for property management, but also a general partnership team to asset manage it for you on top of that. So you actually have another layer of management making decisions for you as the true professionals and people with skin in the game. But it requires you, in my opinion, to have a higher net worth to get more involved in those projects. But it's actually kind of harder to run the deal yourself, even with a property manager, right? Unfortunately, that's the barrier to entry with rental real estate. You need to have money to buy a property to get started.
Yeah. So what does it really mean to exit the W-2 treadmill?
Again, it means different things for other people, right? But I mean, just to put a common data point out there, like, most people will quit their day jobs once their assets produce enough income for them. Single family homes, they're not scalable, but I suppose if you had 30 of them, that would probably create enough, $10,000 of passive income for you at a, two or $300 each. And you would have pretty good diversification doing that. Um, Obviously, a lot of legal liability and headache there, which is why the syndications and private placements are just a little bit more scalable once you become an accredited investor from that point on. But um, imagine you had that much rental properties, right? And it replaced your income, and you spend freely, and you still have some money at the end of the month, right? Like, to me, unless you really, really enjoy your work, which not a lot of people are in that category, that's the when you cut bait and you spend your time doing something else that you truly enjoy, because you've left that stage of life where you have to trade time for money. So in the higher floors of the in my book, I talk about in the third floor and the fourth floor, more the fourth floor, is when you start to develop your own family office. Right, a family office is a term of very wealthy people, traditionally 50 to $100 million net worth or greater. But you could create your own family office today with just $1 million, where your primary focus is not trading time for money at your business or your day job, but it's taking the money and assets that you have and being a good steward of it and investing, having it work for you to create more passive cash flow or income for you in the month to month or year to year basis.
Okay. Like we was mentioning before, well, so why is time and not money the ultimate asset for high earners? And
Yeah, I mean, this is a little esoteric, but in the beginning, you don't have very much money and you have a lot of free time on your hand. As you get more money, it kind of tips the scales, time gets more valuable. Most of my clients these days, they have families, they got kids, um, they're they have more money. They typically pay for more services to save time, right? There's this perpetual exchange for, as you age, more and more, um, trading time or money for time, as opposed to going backwards. Um, this is why grandma and grandpa got all this money, but they don't really have the ability to enjoy it, right? If they can't do it physically, but also they've kind of ran out of creative ways to spend money. Well, when you're younger, you're super creative. Plus, all the marketing to buy all this crap is up in your face all the time. Um, but that's how you kind of know that you're wealthy, when you're kind of like, well, I'm gonna pay for valet, I'm gonna pay for private school, I'm gonna pay for this, because you're spending your time, you're spending your money to save time at the end of the day. And if you're talking about the esoteric, the main resources out there, time is not something that you can get more of, right? Like, I mean, I think the greatest example of that is Steve Jobs. Like, what did the guy have, like a gazillion dollars?
mhm.
And he got his, I think it was like cancer, right?
Yeah,
And all the money in the world couldn't solve, couldn't extend his life out. So, I mean, they always say that, we all got a lot of problems, right? But the guy who has some kind of health scare or something where he's gonna, die of a terminal illness, he's just got one problem. All the problems go away.
absolutely. I don't know if I'm gonna pronounce it correctly, right? But can you explain is it the mindset? Uh,
Yeah, so what I've kind of created over the years, since kind of starting my podcast back in 2016, like back then we would, teach people how to buy little rental properties, and we create this ecosystem, this community of like-minded investors, which actually was super important when we kind of transitioned more to syndications and private placements, because find accessing all these deals by independent sponsors and operators, is very hard to do, right? They're essentially like country club deals, right? You got to know the guy who knows the guy. And what I always wanted is, how do you know the guy is good? How do you learn about this stuff, especially when you're new to this? I mean, you could kind of read my book to kind of understand the game within the game,
Hmm.
but you still need, at some point, you still need the community and the people around you. So, a lot of the way that we'll monetize our group is, put on retreats where people get to meet other people. And then, I kind of mentioned earlier, time is a very valuable resource to wealthy people, but also the wealthier you get, you start to realize social capital is a much more of a something that you people will pay for too, right? Social relationships are the currency of the wealthy, as they say. So that was kind of the idea behind, my community is, get a bunch of people who are, similar net worths. But I think, of course, some people aren't a good fit, but for the most part, people who work hard, especially first generation multimillionaires who weren't born with a silver spoon in their mouth, they have a lot of have a lot of the same value sets, right? The initial struggle, the delayed gratification, saving your money, diligently saving, stepping out there, having the balls to invest, right? A lot of these are the values of a first generation multimillionaire, and I think it's a it's a rare trait set, and I think that's kind of why people really resonate with the community that we've created here.
All right. So, what should first generation wealth builders focus on to avoid costly mistakes?
Yeah, going back to network, a lot of it is just surrounding yourself with the right people. I kind of follow a 70-20-10 framework that I learned when I was in corporate America, where, first you got to learn about it, which is 70% of it. So that's the academic book start stuff. So, check out my book, The Wealth Elevator. If you guys pick up a copy and email team at thewealthelevator.com, the screenshot of the review that you guys do will hook you up with the free PDF and the MP3s, especially if you're like me who doesn't read too well. Um, but just know that's a big chunk of it, 70% of it. But the next part is, or no, that's a small part of it, like the 10%. The next chunk is get surrounding yourself with like-minded people and kind of learning by osmosis, right? I think this is very similar when we were all in grade school and high school, right, and college. But the majority of it is, you got to invest, you got to do it, right? You got to learn by doing. So that's what I would say is, you know, try and apply that. That rubric applies to a lot of things in learning and also investing.
Okay. If someone listening feels stuck despite earning well, what's the first move they should make?
Well, they should check out my book, The Wealth Elevator, and I think part of it is self-awareness, right? I mean, I'll be honest, like if you're, in credit card debt and making under $60,000 a year, don't read my book. It's just going to depress you. I mean, there's a lot of other books written out there for that type of stuff. Dave Ramsey, Susie Orman. There's a huge personal finance blog sphere for that type of content material. But if you're somebody who's conscientious with your money, can save at least 20, 50 grand per year, it's time to get on the wealth elevator and surround yourself with your tribe. Because, I think the general audience out there are kind of, just paycheck to paycheck folks out there, which, you know, I suppose we all were there at one time,
Yeah.
right? But if you're conscientious of where you're at and know that kind of next half step that you're trying to get to, how you're going to do it, like I said, maybe rental properties. You may be already an accredited investor, and you need to surround yourself with a community and get good deal flow of off market types of projects. You got first thing is like always self awareness. You got to know where you're at to know where you're going to be.
Absolutely. Oh man, this has been awesome. But we've come to the part of the show where you get the spotlight and you get to plug away and let everybody know where they can find the book, the websites, everything.
Yeah, they can go on Amazon. Just type in the Wealth Elevator, and again, yeah, if you guys buy it, I think you can do like the 99-cent Kindle version. That's a cheap way of doing it, I suppose. But yeah, leave a nice review and then take a screenshot to team@thewealthelevator.com, and we'll hook you up with the free PDF. So if you're smart out there, you just throw it up into ChatGPT and ask it individual queries based off the knowledge base. Or, like I said, if you're like me who can't read too well and you prefer the MP3 copy, we'll hook you up there too. But if you like podcasts, go to the Wealth Elevator. But yeah, thanks for having me. Appreciate it.
Oh, the pleasure's all mine, man. Thank you for coming on and sharing your knowledge and sharing the information you have, man. I greatly appreciate it. All right. Anything else you want to share before we leave?
No, I think you're good. I gotta jump to a meeting right now, but yeah, let me know when it goes live, and then we'll share it
Oh,
out.
yep. No
Yeah, shoot me an
problem.
email when it
I
goes live.
definitely will.
Okay,
You have a good day.
good man. Bye.
All right. All right. Another great episode is in the books. If you're a high income professional looking to build passive income and long term wealth without sacrificing your career or lifestyle, check out Lane's work at the Wealth Elevator. You'll find resources and a free investor guide linked in the show notes. And if this episode shifted how you think about money and time, share it with someone who's earning well but still feels stuck. You know how your boy Wize does it. Peace out.